Welcome to our lecture series in Financial Basics. Today, we will talk about financial markets and stock exchanges in specific. Let's begin. A stock exchange is an organized marketplace where a variety of securities, such as stocks, exchange-traded funds, or ETFs, bonds, and derivatives, are systematically bought and sold by investors and institutions. These essential institutions form the backbone of modern financial systems by providing high liquidity, enabling accurate price discovery through transparent trading, ensuring overall market transparency, and offering robust investor protection mechanisms. Stock exchanges serve as highly centralized platforms designed to efficiently match buyers and sellers of securities while operating under a comprehensive and strictly defined set of trading rules. Their key functions encompass providing vital market liquidity, facilitating precise price discovery driven by real-time supply and demand forces, and enforcing stringent listing standards to maintain quality. For a real-life example, when an investor decides to buy shares of Apple with the ticker symbol AAPL, the actual transaction is executed on the NASDAQ exchange, even if the investor is simply using their brokerage app on their phone. Before the advent of formal stock exchanges, securities were traded in informal environments, like coffee houses or street corners, which inevitably led to elevated transaction costs, diminished trust between parties, and increased risks. Stock exchanges were established specifically to mitigate these drawbacks by drastically reducing transaction costs, fostering greater trust through structured processes, standardizing trading procedures, and enhancing investor confidence with regulatory frameworks. Historically speaking, the New York Stock Exchange, known as NYSE, traces its foundational roots to the Buttonwood Agreement of 1792, when 24 brokers signed under a buttonwood tree to create the first set of organized trading rules. Financial markets are distinctly categorized into primary markets, where securities are issued and sold for the very first time, like in an IPO, and secondary markets, where already issued securities are actively traded between investors. Stock exchanges predominantly operate within the secondary market realm, where they expertly facilitate trades of existing securities directly between various investors worldwide. Well-known organized exchanges such as the NYSE, NASDAQ, and London Stock Exchange are centralized venues that are intensely regulated, thereby ensuring fully transparent pricing and upholding rigorous listing requirements for all participants. By comparison, over-the-counter or OTC markets rely on decentralized trading via extensive dealer networks, which typically feature lighter regulation and correspondingly lower transparency levels than formal exchanges. All trading activities on a stock exchange are powered by advanced electronic order matching systems that handle vast volumes of trades with speed and precision. Investors submit their buy or sell orders through brokerage firms, which then electronically route them to the exchange's central matching engine for execution based on established price priority and time of arrival priority rules. Prominent major global stock exchanges include the NYSE and NASDAQ in the United States, alongside international giants like the London Stock Exchange, Tokyo Stock Exchange, and Shanghai Stock Exchange. In order to have their shares traded on these exchanges, companies must fulfill specific and stringent listing requirements, including a minimum market capitalization, strong corporate governance standards, and consistent financial reporting. Stock exchanges deliver critical benefits to investors, such as superior liquidity for easy buying and selling, transparent pricing that reflects true market values, comprehensive regulatory oversight, and minimized counterparty risk through secure clearing processes. Without the presence of stock exchanges, investors would confront substantially higher costs, much greater uncertainty in transactions, and diminished overall market efficiency, which emphatically underscores their pivotal and irreplaceable role in the financial ecosystem. Thank you for watching our lecture on financial basics focusing on stock exchanges. See you at the next lecture.